Okay, I think we start. Welcome to our panel today. It's good to see that compared to last year, we have more real people here. Because the fake people, I remember last year we had probably, I don't know, 80% of the fake people and 20% of the real ones. So that's very good. Welcome to see all of you back. We have 20 minutes, it's not too long. I am happy to have here highly qualified panelists. I start with Sandra Crowl. She is from Carmignac Risk Managers, and she is responsible for the investment team. Responsible investment team, very good. Serge Weyland from Rothschild, the CEO, and then we also have Antoine, Bonte, Langham Hall, AFM, also custodian bank responsibilities. So we have quite a diversified team, and today we want to talk about this taxonomy beast, so to say. What will it change is the title, and how to avoid greenwashing. Yeah, so it sounds like two titles, but they are interlinked a little bit. And also, if you look at the title, it's maybe a bit misleading, because what will it change is one aspect. What did it change already is probably also on your minds, because it changed quite a lot. If you look back at the last 1.5 years, you had to do a lot of new internal restructurings. You had to look at new rules. You had to see how you finance all of this costs which are established. What about the risks for your company resulting from the taxonomy element? So there has been already a lot of different elements which came into play. Today, maybe we talk a bit more about what to expect, what's coming. And I would hand over to Sandra first. That's your burden of a lady to speak first. And give us your view, maybe also a bit of from a practical experience. What do you expect? What's coming? Yeah. Is it getting worse or better? Let's see.
Well, I think everyone in this room would welcome to have a set of standards and a set of a level playing field when it comes to measuring and declaring your environmentally focused investments. So I think we should really congratulate the Commission for getting on top of this. And 3 years ago now, when they did announce that, they didn't want to leave that up to the national authorities, but wanted to bring this into law, because there was no way out than to create a law around environmental activities. So we must be positive about this, and it's obviously brought several challenges, which we'll talk about shortly, but most importantly, what else is it bringing other than for asset managers and investee companies to be very much more conscious about their environment, to be able to provide us much more technical details about how they measure their own footprint. And we'll have more about that in 2024 when the CSRD laws come into play, and investee companies will be required to give much more transparency on ESG indicators, so very much needed for us. But more importantly, what is ahead of us? We know that we have now the full definition, that in itself can be read slightly differently depending on how you map these environmental activities. We have the full definition of those for climate change mitigation and climate change adaptation later on this year. And I'm a bit concerned that we're already June and we haven't had more information, so I think it may push over into 2023 for the other 4 objectives, the technical standards required around the 4 objectives of circular economy, pollution, protection of the biodiversity and ecosystems, and also water and marine resources. So we'll have information around how we would classify investments that would promote those environmental objectives. And we will naturally then have new flows, just like we've seen already in the new renewable space for climate change mitigation. We'll have new innovation and new asset flows is the purpose naturally of the Commission into areas like sustainable water, pollution treatments, green agriculture, that's a very important one, and also monitoring and measuring toxic waste in a much more efficient and more proactive manner. So I think the actual data around those 4 last objectives are going to be even more challenging than the first 2 objectives. And we've seen that already in the taxonomy alignment figures that we have been able to, at Carmignac, being able to measure without any estimations at all. We use just revenue-based data. And it's been, if I may, easy to measure our alignment for any investment in green technology, any investment that is a pure play company that is providing or enabling, for example, EVs, battery producers. That's 100% allocated to a taxonomy alignment. There are no technical standards necessary for that particular subsector. So that's been an easy exercise. What hasn't, of course, is looking at companies that maybe a building insulation company, for example, that is not providing the thermal conductivity data that we need to actually measure the technical standards for that particular company. So we'll get more data, and I'll just finish on my last point. Of course, taxonomy is not alone in the government initiatives or UN initiatives. We naturally have already, since 2015, had the 17 SDGs, which is being used as a very investable, not all of them, not all of the 17, but investable framework. But also, let's not leave out the UK with the SDR that is requiring that TCFD reporting become mandatory within the next couple of years. We've also got the climate Article 29, which requires in France for companies over 500 million assets under management to declare a climate policy, climate target also by 2030. So if taxonomy was alone in this journey, I think it would have perhaps less impact, but the fact that in Europe we have so many benefits, given it's led by the government, led by legislation, led by the younger generation, that we have a high success rate, I believe, bit by bit for the taxonomy to be board-based.
That was really detailed, very good, very interesting, but I sensed or heard that there will be more challenges ahead, not only with you to the new objectives kicking in beginning of next year, but also otherwise. But Serge, we discussed beforehand, and you voiced the view that you think this is taxonomy, nevertheless, a good framework. This is what we discussed. I share this view as well. What practical challenges do you see on the road ahead? Yeah, good ones or negative ones?
Well, thank you, Marcus. Oops, turning on the mic here. You have to turn it on.
Good.
Okay, now it works. Good morning, everyone. Thank you, Marcus. I will speak a little bit about us as an asset manager and also as a service provider, but I think primarily from an asset management perspective, indeed, as Sandra said, I think we should be very grateful that the Commission has come up with this framework. It is obviously still work in progress. I think it is a journey rather than something that's all set and defined, as we know. I think what some of the practical challenges that we've seen, I think, indeed, is the fact that from timing-wise, CSRD comes into play in 2024. We know that, of course, a lot of the European issuers are already providing the data, but they are not fully there yet. So that's definitely a challenge. Then there's, I think, when you, as an asset manager, have global allocations, your European asset pool is probably already well covered in terms of the environmental adverse impacts or measurements. But then, outside of Europe, it becomes a little more complicated. If you look at emerging market funds, that's even more the case. But nonetheless, I think we should also keep in mind that if you are an Article 8 fund, and if your investment policy or you have not defined specific objectives or climate related, how did you put it earlier on, Sandra, process that you have committed to, then you're not yet in a position to having to disclose, you know, and report on the detailed numbers. So this is something also to take into consideration, and I think it should also enable people to, you know, start getting ready, embed, of course, ESG into their investment process, but without having to worry too much about, you know, the data and the metrics. Maybe a last comment on the data. We've seen also the cost of data skyrocket, and this is a concern, I think, especially for boutique asset managers, which I find a little sad, because I still believe that there is a vibrant community out there, you know, providing performance, but data is definitely going to be a challenge. I mean, we've looked into it now. It's we have additional costs, probably close to $500,000 per year, which is you know, something that is heavy to shoulder. So these are just a few thoughts from my side.
Good, it works.
That's not including your technology budget.
No, this is pure
ours
data.
would be double that.
Pure data.
Yeah.
Pure.
Yeah.
But that's quite a high cost position, I would say, just for this element of data. So that's one challenge. Antoine, from an AFIM perspective, maybe, how do you see the role of the AFIM or service providers in general with you to the compliance check, which is, 1 second.
Sorry.
So, good. We didn't test this before, sorry. Yeah. So, yeah, your role for the compliance check with you to the taxonomy framework. What do you see? What do you think will be in the future increasing in your role, apart from the costs, of course, which we heard already now?
So, yeah, good morning, everyone. So, yeah, as an AFM or depository, so specialized in private markets, so real estate, infrastructure, private equity, and private debt. Obviously, all the ESG regulation will impact their roles from compliance, because, as you know, the AFM depository need to check the compliance with investment strategy and compliance with investment restrictions, and these roles have been reminded recently by the ESMA supervisory briefing that has been issued this month. A significant part of one of the first challenges I would like to mention is the fact that a significant part of our clients are a non-EU fund sponsor. They just digested the IFMD regulation, the AML KYC directive, the BEPS tax substance regulation, and now we come and see them with all this ESG taxonomy regulation, and believe me, it's not always easy to explain them, and sometimes not scaring them. Because more and more they see that as a kind of a new barrier to enter into the European market, to market the product. So yeah, I would say this is the first challenge. And also, so we have seen recently as well that the host AFM role have evolved regarding the marketing, especially when you have a fund sponsor who doesn't have the MiFID license. Sometimes the host AFM provide a regulatory coverage to help them to market the product in Europe, in particular under the chaperoning model. So the question that we are discussing as well internally is how this will impact the chaperoning model and the role of the AFM in that respect. Because, for example, under this model, the host AFM need to attend, participate to all significant discussion with potential investors. And the last point I would like to also raise is, as you know, I mean, a host AFM depository need to document their works. Because the CSSF would expect them to check all the compliance with AML, with the OESG regulations. What we try to do to properly document that, it's to leverage on the tool that has been developed by the ILPA, so the Institutional Limited Partners Association, that created a kind of ESG assessment framework. And we find that useful as well for us because it's initially for investors, but at the end of the day, investors that host AFM wants to check what the GPs are doing. And it's a tool that basically enables to evaluate and understand the various stages of ESG integration amongst our clients. And it's helped us to really evaluate, benchmark the GP responses to due diligence effort, to prepare some goal-setting conversation with them, and also to measure the ESG integration progress over the time. So we're still under implementation, but we found that it's a good starting point to document our works in that respect. And maybe a last point. Especially in the renewable energy sector, we are seeing as well an increasing demand for independent directors who have an expertise in ESG, because clients, I think, would like to get some added value and help them to get some help to enable them to go through this ESG journey.
Thank you, Antoine. That's an important point, independent directors, so they also need to educate themselves from time to time. Maybe two last points before we come to an end. The first one is control level. We also said it's important to, in the organization, to show that you have a good control level, who's doing the checking, whether taxonomy is fulfilled, and also with future investors. Sandra, you said you have a very good kind of control level. It's not only one level, but two. Auditor might also have to check something. Maybe give some short insight into this. Huh?
Yeah.
Thank you.
The way we're structured in the company, the investment managers and the analysts have total final responsibility of ESG analysis. It's part of their job. In fact, they're remunerated for the extra financial analysis that they perform. The responsible investment team is a center of expertise, and we do lots of deep dive in particular themes, for example, the most recent gas and nuclear in the context of taxonomy. But it's a team that also performs ESG analysis. But the point here is that my reporting line is to Maxime Carmignac, in fact, who represents sustainability at the board level. And I do not report to the head of equities and the head of fixed income. Our risk management team have the data in place and the method of measuring our prospectus rules, whether they be low carbon targets, sustainability objectives, 20% universe reductions, any of these aspects that we have employed within our funds to render them to either have environmental or social characteristics or sustainable objectives. The risk management team do a second level control and have as much, we hopefully to get to ex ante extra financial criteria control. And some part of it is at the moment ex post, but we're getting there with our technology and a very big technology budget. So I think that's it's not foolproof naturally, but it's a way to make sure that we are true to what we see as our own internal rating, proprietary ratings, for example, and that the ratings are being allocated in a very fair, proper, and well-researched manner.
Very good. I think this was a smooth handover to the topic of greenwashing. Just who was able to follow. So all of what we discussed, of course, is also helping to avoid the greenwashing, because in at least my personal view, I think nobody in the market should or would do the greenwashing on purpose, because this is something which will harm your reputation and also have other consequences. So it's rather to see how can you avoid to slip into this greenwashing theater. And here we told you about the challenges. So if you look at the challenges, if you find the right way to cope with them, so to have sufficient control levels, also to have the right data, maybe to invest a bit of money to pay for the data, this all will help you to avoid the bigger consequences of getting into a picture in the press. So I don't know what happens if people tell that you did not play by the rules. But on the other hand, also some things are not quite clear. I think also with the nuclear, which Sandra mentioned, this is difficult. Serge, I think you once said it's also sometimes difficult to educate the investor if they have to move a fund from Article 6 into 8. What's new? What do they have to do? So I think this is also something where they have to pay attention to, and which helps you to avoid the greenwashing.
It works. Yeah, no, so I think there, well, as you said, I completely agree that I think the framework and taxonomy should help avoid greenwashing, I think. And it pushes all of us to be genuine about what we do. So being able to, if you make a promise in your fund documents, then you have to deliver on that promise, and this will be measured and disclosed. So I think this is ultimately a good thing. We discussed about some of the challenges around data, but I think that's going to be a journey. I think the other theme that we have looked into quite a bit, we, as an asset management house, we manage 70 billion of assets, of which 20 billion are in illiquid in private equity, namely strategies, and where we have also impact funds. I think it's much easier to communicate in private markets, especially when you have impact strategies, because you can be very tangible about what you do. It is much more difficult in the liquid space because even with the recent stories in the press around engagement votes at AGMs that can be used against you. So we have to be, I think we have to be as an industry very humble and very honest about what we do. Education is indeed also, and you mentioned it as well, Antoine. We went through, for example, onboarding a delegated manager based in the US, to manage, first of all, European products, and then educating them about how they can incorporate ESG into their investment process. It is also a journey, but I think this has also been the political intention of Europe to be at the forefront of ESG impact and impact investing, and I think it's ultimately a good thing. But it is an important duty of all of us, also us as service providers, if we bring in new strategies, managers from abroad, to make sure that they adhere to the framework and also adhere to the high standards that we impose ourselves.
Yeah, thank you, Serge. I think that was a really good closing remark already. I mean, we're already at the end of the time. So thank all of you for your patience. I don't know if there's still room for some questions. You are the ceremony master? No? 1 or 2 minutes? Okay, any questions from the real people or the papier-mâché people? I don't know.
Hello, my name is Laurent Kops. Thank you very much. I would have a general question on the data, because we understood that ESG and sustainable finance is a big trend in the future, and monitoring all this is quite difficult, requires a lot of data. One of the variables, so let's say 3 variables here, are the environment itself, which is, predicting the weather is more difficult than predicting the stock market sometimes, so this has an impact. Second, the social opinion, which can always change, and depending how the media might argument one or the other point. The third is government itself, which, in Europe, governments change. It's not like in China or in Russia, where you have people not leaders for long term. Here, politics change, and this has an impact too. 2 examples were given by Mr. Carmignac. The one was in Poland, where they want to close the company, so this has a social impact, but the company itself, you say it's not good for the environment, and this sometimes is discretionary. As for example, Tesla with its electric cars also lost in rating, and there are now some petrol companies having a higher rating than Tesla has. How do you confront these variables, so the political government, which influences the markets and creates awareness to the population, and makes the laws on what is good and what is bad sometimes. The social and then the environmental variables, how do you take this into account for monitoring of the investments?
I can jump in perhaps on a first response in those three topics. So to start off on the government side, the German government had a very large control in when and how quickly RWE could transition away from coal. So it was a very important part of consideration of whether this highly important utility, which still has significant coal, was going to be part of a sustainable portfolio. Perhaps not all sustainable portfolios, but I think that this highlights the necessity not only just to finance either enabling companies or companies that are contributing through green energy, through green technologies, we also must accompany the transition. That's without even talking about gas and nuclear. We're talking about going back to the basics of still having enormous amount of coal as the primary source of energy in Poland and Germany. So governments are important, but we've also got the benefits of having a transitionary budget at the European level, helping households for the extra costs of the transition costs of energy. So I think governments are playing the role, and the Commission is aware of the transition costs. On the social acceptance side, I think there is now an acknowledgement that we do need transition, and hence the acknowledgement for some countries that we cannot face the transition without nuclear. It's of course very inconsequential when we look at carbon emissions, and we've made lots of progress in small reactors for the safety. We obviously haven't resolved the waste issue. So I think social mercy is important. It's obviously less accepted in Germany and Austria, but it's important. And as far as the environmental change, I mentioned TCFD reporting before. To be able to measure physical risk and transition risk is a huge step forward to be able to monitor the environmental risk going forward. And I think all of us are stepping up to the plate to respond to TCFD on those scores, and that will help us actually understand the environment, the physical environment in which we're operating in, to find out what those risks are.